Okay, great. So thank you so much for joining us today for the second event in our series on how regulators and advocates can harness physical and financial risk data to tackle the climate emergency. I'm Madison Condon, an associate professor of law at Boston University. And I helped organize this event along with our co-sponsors, our co-hosts, the State Impact Center at NYU School of Law, Woodwell Climate Research Center, and the Massachusetts Office of the Attorney General. Thank you so much to our hosts. There is CLE credit for this event, so I will reveal the CLE code sometime within our session for those who know what that means. It is an honor to introduce our opening speaker, Professor Rob Jackson of New York University School of Law. Professor Jackson served as commissioner of the US Securities and Exchange Commission from 2017 to 2020. He writes on a range of topics related to law and financial regulation, including insider trading and investor protection. And his scholarship appears in many top journals. So with that, thank you so much for being here, Rob, and take it away.
Well, thank you so much, Professor Condon, for that very kind introduction. Hello, all. My name is Robert Jackson. As Professor Condon mentioned, I, until recently, was a commissioner on the U.S. Securities and Exchange Commission and have returned now to teaching law here at NYU. I am delighted and really quite honored to be introducing today's event because you're going to be hearing from the cutting-edge leaders, most of all herself, Professor Condon, on the subject of where we are headed in dealing with the climate crisis we all face as a society. I want to start this morning just by teeing up some of the concepts that I think you'll hear a little bit about, sharing with the group where I think the SEC is now and will be going on this crucial subject when it comes to transparency on physical climate risk. I want to highlight a few early questions that I think you're going to hear from the panelists about, and then I'm going to get out of the way. Because if I were you, I would be here to hear from the experts on today's terrific panel. And I certainly want to hear from them too. So I'm going to very briefly highlight where we are at the SEC in their rulemaking process on providing transparency on the physical climate risks that public companies with securities issued in the United States, where those rules stand now. So first, I want to highlight for you what I want to share really is that these rules are coming imminently. I predict there will be an open meeting of the SEC in less than a month to propose the first comprehensive attempt of the U.S. Securities and Exchange Commission to require public companies to disclose their the physical climate impacts of their activities. I think there are currently two subjects that are being debated at the highest levels of the Commission's policymaking apparatus that we will see reflected in the SEC's proposed rule. The first is whether or not Scope 3 emissions should be encompassed in the required disclosures. That is, whether or not emissions effects beyond the immediate control of the issuer and its contractual counterparties should be the subject of disclosure rules issued by the SEC. There are arguments, of course, that without that information, the disclosures will be much less useful. There are other arguments that providing them will be costly because for firms to reach that far into the production apparatus will be expensive. Of course, those who fully understand how urgent our climate crisis is might say, well, to the degree that firms haven't yet reached that understanding of their effects on the world around them, maybe they should. And maybe the SEC should play a role in ensuring that they do. I can tell you that is a debate that is happening right now at the Securities and Exchange Commission as it considers how to handle the issuance of these rules. The second question that I know is being hotly debated, and it's a difficult one, is the involvement of third-party auditors and assurance firms in making sure that the data produced by a new disclosure regime means something. Now, everyone on this panel, and I suspect everyone on this call, understands that a disclosure rule that provides investors with information that is not comparable, that is not clear, and doesn't have a relationship to the real underlying activity of firms that are affecting our climate, that kind of rule doesn't do anybody any good, except for the lawyers who get to argue about it. And for that reason, I know that there are members of the commission that want to ensure that there's some assurance with respect to the production of these numbers, whether it's from an accounting firm or a consulting firm that specializes in that subject. On the other hand, there are, of course, limits to the SEC's authority and limited development of standards among practitioners on that subject. And so there's some debate as to how far the SEC can or will go. It was publicly reported last week that there has been some debate about that at the commission. Senator Elizabeth Warren sent a letter to Gary Gensler, the chair of the SEC, highlighting the need for prompt action and expressing her expectation that a rule will be coming soon. And here, as in many other things, I think the senator is correct. I think a proposed rule will be coming relatively soon. Of course, that's just the beginning, not the end of the conversation on providing transparency in this area in the United States. First of all, everyone on this call knows that the US is years behind our European counterparts and entities around the world in developing these rules. So we've got a distance to go. Also, those of you familiar with administrative law know that a mere rulemaking proposal will be followed by a comment period and then a finalization of the rule. And then, of course, inevitably, industry will sue the SEC. And there'll be some debate among a randomly selected panel of judges about a subject that eludes me, but my administrative law colleagues assure me means something. In all events, whatever one thinks about that, I can tell you we're at the beginning of a very exciting rulemaking process. And I'll tell you, because we're so far behind, because the United States is still catching up to the world and the market on this subject, getting this right is crucial. Because the nature of American government, certainly my experience at the SEC, was that you might not get more than one try at this. And so I'm certainly hopeful that the proposal the SEC comes out will stimulate a robust discussion among panels like this one and audiences like all of you on the subject of what the best path forward would be. I'll highlight briefly a couple of questions that I hope to hear from the panel about, and then I'll turn it over to Professor Condon and her colleagues. One of the things I think we certainly should discuss today is really what can we expect companies to disclose about their physical risk exposure. We should also talk about whether or not this kind of disclosure mandate disadvantages smaller firms over larger ones. I'll give you an example. Just a few weeks ago, BlackRock, the major asset management firm, announced, well, we have done a Scope 3 disclosure. And so we are familiar with doing it and we think it can be done. Well, many in the market responded, if you're BlackRock, sure, but what if you're not? And do we want to put smaller businesses in a position where yet another regulatory burden puts them at a competitive disadvantage to the BlackRocks of the world? Another question is, when the SEC moves forward with the rule, how will it be enforced? Do they have the expertise to look at a disclosure about GHG and to bring an enforcement action if it's wrong? And also, do we think that these disclosures should be designed not just to inform investors, but to inform other stakeholders like the government, either here or around the world, or the citizens who are forced to breathe the air and drink the water that is impacted by American companies' behavior? Those questions and more, I expect, will be fully answered by the panel I'm handing the stage over to now. Professor Condon, I'll leave it to you and our colleagues to talk through some of these fascinating issues. I'm so looking forward to the conversation.
Professor Jackson, thank you so much. You've really gotten me excited to hear from all of our panelists today. So a quick note on procedure, please use the Q&A function. And we're gonna open it up to questions at the end, but I'll also be observing that throughout the panel. We won't give lengthy bios for our speakers. They're all extremely accomplished, but we do have a brochure that accompanies this panel. So there's a nice PDF. You can look at all the things that they've done and their nice headshots. So I won't be introducing them at length today. So we're going to dive in because this is a really fast moving topic and I really want to hear from them. So we're going to hear from Nina Chen, Executive Deputy Superintendent of the Climate Division at New York State Department of Financial Services. We're going to hear from Wendy Cromwell, the Vice Chair of Wellington Management, Dave McGlinchey, Head of External Affairs from Woodwell Climate Research Center, and Marilyn Waite, Managing Director of the Climate Finance Fund. So I would like to, maybe I could switch, maybe I would like Marilyn and Nina, if you guys could as a group, maybe set the stage for us. Nina, you can go first and just say a little bit like, what are regulators doing right now? You are a regulator. What did you do in your position as a regulator? And what motivated you to start thinking about climate risk as a financial risk? And then we'll turn to Marilyn to talk more about the private sector and what they're up to. So take it away, Nina.
Yeah, thank you very much. Thanks, NYU, Woodwell, and the Massachusetts Attorney General's Office for organizing this very important discussion. So I'm Nina Chen. I work at the New York State Department of Financial Services. Probably a lot of you are not familiar with what we do. So we are the financial regulator for the insurance companies that are licensed in New York, and also the banks that are chartered in New York. In the US, financial regulation is very fragmented. So insurance regulation, insurers are only regulated at the state level. Banks can be either federally chartered or state chartered. So we supervise about 1,800 insurance companies with assets over $5.5 trillion and more than 1,400 banking and institutions with assets totaling more than $2.9 trillion. So I have been with DFS, Department of Financial Services, for close to 2 years. And the reason why this position was created at a financial regulator is because we see climate change as posing potentially significant and material financial risk to the system. So as a regulator, to ensure that all banks can pay their depositors and insurers can pay the premium, pay off for the policyholders, we need to make sure that they stay safe and sound in the face of climate change. So DFS was the first US financial regulator to join the network of central banks and the supervisors of greening the financial system. It's an international network. We joined in 2019. The Fed joined in December 2020 after the election. OCC joined mid last year. We're also an early member of the Sustainable Insurance Forum, which is the network of international insurance supervisors working on sustainability and climate. So very quick highlight on what we have done. So we have issued high-level expectations for banks and insurers to integrate the financial risk from climate change into their governance, corporate governance, organizational structure, business strategies, risk management, and start developing public disclosure approach related to their management of climate risk. So we're the first US financial regulator to do so. Professor Jackson said earlier that the US is years behind compared to Europe and even Asia. So we did benefit from being able to see what other regulators have done, how the industry have reacted. And then we issued these sets of high-level expectations at the end of 2020. And last year, in November last year, we also issued detailed guidance for New York domestic insurers on managing the financial risk from climate change. That was after a very extensive, rigorous consultation, public comment process. We have also started examining our insurers on their management of climate risk since 2020, since last year. So examination is the main way of a financial regulator to make sure that the entities they regulate and supervise stay solvent and they can pay the insurance claims when policyholders need them. So we have been engaging with our insurers in dialogues, providing feedback on how they are doing in their risk management. And we also have taken a range of approaches to support our banks and insurers on their journey, such as organizing webinars and roundtables. So I stop here.
Great, thanks so much, Nina. I have a lot of questions I want to ask you about that, but we'll turn to Marilyn. So Marilyn, from your perspective at Climate Finance Fund, what is the private sector up to, and like, do they care about this? Who's looking for this information and why?
Thank you, Madison. I'll answer both for private sector actors, but also especially the financial system, but also bring in some examples in the policy realm from the other markets we cover, including the European Union and China. So over half of the listed companies are already measuring and disclosing their carbon emissions equivalent or greenhouse gas emissions, according to CDP. So the market really has leaned into this level of information. Right now, it is more expensive to go out and have this information on a systems level because it is not widely available for all the firms. So that's why we need the system to kind of move in this direction so that we can actually lower the cost, have the economies of scale, because now everyone is mandated to have this kind of measurement and disclosure. So over half of listed companies, the Partnership for Carbon Accounting Financials, which groups together asset managers and banks, now has over 50 trillion of assets under management that are measuring and disclosing scopes 1, 2, and 3 emissions. Importantly, scope 3 emissions being the most important. Over 80% of emissions in the real economy come from scope 3. And for a bank or asset manager, that's your financed emissions of your loans and your investments. So huge market uptake. And it's not, the good news is that it's not just BlackRock. Actually, when PCAF, the Partnership for Carbon Accounting Financials, was first brought to the United States from the Netherlands, we actually had seen smaller banks and credit unions being the first, the leaders in the system. So you have Clearwater Credit Union in Montana, Self-Help Credit Union, multiple states that were the first adopters to actually do the work and measure and disclose. So it's definitely beyond doable across all sizes of institutions. Now, I will say that the best examples of market actors taking risk into account are those that are incentivizing climate solutions and mandating this transparency in action. We would be kidding ourselves to believe that we can somehow risk manage our way out of the problem. Climate change is unlike anything else. It's unlike point source pollution. It's systemic, pervasive, and makes all other risks worse. Therefore, the best way to actually manage the risk is to actually decarbonize the air and recarbonize the soil. And Project Drawdown has given us the blueprint for the 80 solutions or more that we can scale now. So I'll just highlight 2 examples from China and the EU as we have this discussion focused on the US. So in China, we have seen leadership from the central bank, People's Bank of China. So China's equivalent of the Federal Reserve. They have introduced last year a carbon emission reduction facility. So all the banks can borrow up to 60% on qualifying loans at an interest rate of 1.75%. Now the going rate, the loan prime rate is around 4%. So significant discount and a recognition of risk, but most importantly, incentivizes lending to solve for that risk. In just a few weeks ago, the European Banking Authority, EBA, mandated scopes 1, 2, and 3 emissions disclosures for all EU banks by 2024. And that's for using 2023 data without any exceptions or caveats or thresholds.
Thank you so much, Marilyn. So thank you for setting the stage, both Marilyn and Nina. We're going to turn to hear from both Wendy and Dave. So they both represent 2 sides of a very interesting partnership, and they're going to tell us about each of their sides. So maybe, while it seems like there's a concern that the market is broadly ignoring climate-related risks, certain actors have started to tackle the problem like pretty aggressively. So maybe, Wendy, you could explain what Wellington's journey of thinking about climate risk has been and why that led you to partner with Woodwell and why that has been a useful partnership.
Sure, thanks, Madison. And maybe it's a good time to bring up that one slide that we thought we might use. I'm Wendy Cromwell. I'm Vice Chair, Head of Sustainable Investment at Wellington Management. Wellington is a large global asset manager. We manage about 1.4 trillion in assets on behalf of clients, typically institutional clients. When we looked out into the marketplace in the 2010 to 2017 timeframe, we recognized that there was a lot of work being done on transition risk and understanding transition risk and understanding carbon footprinting and understanding the emissions related to your portfolio. And that work has continued and needs to continue. Where we saw the gap was on physical climate risk, where investors like myself and my colleagues really weren't contemplating the impact of heat, drought, wildfire, hurricanes, floods, access to water issues on the securities that we own on behalf of clients. So just a quick reminder, transition risk is associated with the left side of the slide, where you're thinking about how policy or regulation or technological disruption may affect the high emitters. It can be a bit behavioral because you're trying to anticipate, will we get a carbon price? Will people change their preferences? How will that impact the securities that I invest in, et cetera? that drives a need for mitigation, bringing down all of those real world emissions. On the right-hand side, we're talking about physical climate risk, which is the effect of those emissions, as I said before: heat, drought, wildfire, hurricanes, floods, access to water issues, water scarcity, air quality, etc. And that those physical risks also have an impact in a time frame that is investable in our portfolios on the securities that we hold. So we see it as our duty to both consider the transition risks and the physical risks. But we didn't have a way to do that. So we reached out, we actually evaluated a large number of vendors, potential vendors, to bridge that gap between climate science and finance. And we can take the slide down now. And what we ultimately determined is that investors are inherently researchers, and that they weren't going to accept the output of a vendor-based solution, at least our investors. And so we needed to actually build the capability from within, and we needed a research partner to do it with. And Woodwell Climate Research Center is a highly credible, very pragmatic, implementation-based research partner. And I love to tell this one quick story about that I think is emblematic of just this divide that we saw in capital markets. When we first started the partnership back in 2018, we sat down with Phil Duffy, who was then the head of Woodwell, and we said to him, Phil, we really want to understand heat, drought, wildfire, et cetera, in basis points. And across the table at 280 Congress in Boston, he said, what's a basis point? Now, if you're not in finance, that might not be funny to you, but that's a word that we use every day. That's our language. That's how we speak. We could have easily turned, that's a true story. We could have easily turned the tables, and he could have said to us, you know, as investors, you should be considering RCP scenarios. And we would have said, what are RCP scenarios? And just that story is emblematic of these two very analytical disciplines really not speaking the same language or talking to each other. So how could physical risk be taken into account in capital markets if we don't even know the language to speak when we're observing and analyzing physical climate risks?
Thank you so much, Wendy. That was really great. So Dave, you're from Woodwell. How has this partnership been useful to Woodwell? And maybe could you talk a little bit about the challenges of communicating climate risk to people outside of the discipline?
Absolutely, yeah, thank you. So first, just as by way of brief introduction, Woodwell was founded in 1985, originally as the Woods Hole Research Center. And today we work around the world conducting research in collaboration with policymakers and decision makers such as Wendy in order to study a range of strategies to immediately address climate change. We study everything from carbon sequestration solutions to the kind of climate risk assessments that we're talking about today. In terms of how this partnership has been useful, our entire impact model is based on partnerships with end users, partnerships with organizations like Wellington, who have such a big footprint, can affect so much change, and are eager to kind of understand the science better to inform their decision-making, inform their policy. So being able to work to put our science to use with a partner that operates at Wellington scale has been just invaluable. The challenges, and they are challenges, but I think as Wendy illustrated, they kind of have a good ending, were largely based around the shared vocabulary that Wendy just discussed. One of the keys to our successful partnership with Wellington, and really any successful partnership that we have with an end user, is that shared vocabulary. And to achieve that, first, we need to understand their questions and their priorities. I think too often scientists show up and want to tell their partners or their end users what's interesting to them. But what really makes this useful and kind of actionable is the idea that we take the time to understand the questions that they want answered. And then, of course, the partner needs to gain a better understanding of the science, as Wendy was just alluding to, understanding RCP scenarios, the climate modeling process. And the way you make this happen in both directions is with transparency and education. Our scientists put a lot of work into being as transparent as possible and educating the Wellington team on the science. And the folks at Wellington have thrown themselves into it as well. I would say that our relative, our success in establishing a shared vocabulary is really an indicator of how successful any of our partnerships will be. The other directly related challenge, but then ultimately success, is moving from kind of high level climate change information to identifying relevant thresholds. You want this information to be actionable. You want it to be directly relevant to a decision maker's everyday world. And so kind of giving general heat trends is not as useful as understanding where wet bulb temperature is most relevant to agricultural output, for example. But fundamentally, when you take the time, when you put in the time to build that shared vocabulary, it sets the stage for success.
Thank you so much, Dave. So this undertaking that you've begun with Woodwell and Wellington, it obviously requires like a massive amount of data crunching with a lot of uncertainty, right? Like, we know that certain things are going to happen, but they have like a large error bar, and we're constantly learning more. So I was wondering, actually, Nina, if I could turn to you. You've thought maybe more deeply about this problem from the transition risk side, but maybe regulators will begin to think more about the physical risk side. Are there lessons that you can offer about like how you address paralysis in the face of uncertainty? Like, how do you as a regulator think about data scarcity or just not knowing the right answer immediately?
Yeah, that's really a great question. And that was also what we heard from many commenters when we during the public input period for the insurance guidance that we issued in November. So that's why we actually added a section on uncertainty and data gap to explicitly address that. So we recognize that many aspects of climate change and the government's and society's response to climate change are still evolving and unknown, but uncertainty and data gaps do not justify inaction. There has been significant advancements in areas like climate science, methodology, and disclosure, as evident by the 6th assessment report of the Intergovernmental Panel on Climate Change, IPCC, the Network for Greening the Financial Systems, the international network I mentioned earlier, which has developed a set of climate scenarios, and also the increasing adoption of TCFD, the Task Force on Climate-Related Financial Disclosure. So technology exists today, provided by rating agencies, asset managers like Wellington, specialty service providers, think tanks like Woodwell, to quantitatively assess the resilience of investment portfolios to transition and the physical risk and a range of scenarios. So in our guidance, we talk about both physical and transition risk, and also talk about the different timeframes that they may manifest in themselves. So another thing to keep in mind is that the precision of the data we need should be driven by the decision the data are going to be used to inform. So many expectations in the insurance guidance we issued, we don't think they are affected by uncertainty or data gaps, and therefore can be implemented with relative speed and confidence. So for example, we say insurers should establish board governance and organizational structure that supports the effective management of climate risk, and also develop their expertise and capacity to assess and manage the risk on both their underwriting and investments. So we think, given the current knowledge of climate risk, these actions should be taken with speed. And we actually have a timeline for implementation, which is by August 15th this year. By contrast, the implementation of other expectations in the guidance, such as setting risk tolerance and limits, will require more iterative approach. And the insurers need to update and refine their decisions as new information is obtained. Scenario analysis, which is a climate-related scenario analysis, is a hot topic and also a very sensitive topic. There we say, it should be exploratory and focus on understanding the potential material climate risk and avoid creating a false sense of security and precision in the results. And then lastly, I also want to emphasize that institutions are not just passive takers of data. They also can be active creators of data. They can fill the data gaps by collecting data from their customers, requesting data disclosure from the companies they invest in, and of course collaborate with peers, academia, and the regulators, such as the collaboration we're seeing between Wellington and Woodwell.
Great, thank you so much, Nina. So Wellington is a very large active manager, meaning that they make and advise decisions about whether a stock is overvalued or undervalued, and then they make a decision whether to buy or sell it or engage, but they make decisions about which stocks to own. So this question is more for Marilyn. Do you see, when you look out in the investment landscape, do you see a difference between how active managers and passive managers are sort of approaching this climate question? Or what would you say about sort of like the landscape of how different investors are demanding or using this risk?
So I guess there are active strategies, passive strategies, but also hybrid. And in general, we see that show up in the fees that are charged, so the basis points, the number of basis points. And I would say we're seeing climate finance related or climate financial related risk throughout. Most of the benchmarks and index providers have various levels of ESG, climate friendly, SDG aligned versions of the index. What we're not seeing though is the mainstreaming by default, the climate friendly or decarbonized versions being used widespread in the industry, whether it's passive or active, because both types of managers will still benchmark against these indices. So we're still seeing the dominance of the MSCI 100 or World Index, versus the MSCI low carbon version. There are a number of third-party rating agencies. So I'm going to list off a few: FTSE Russell, MSCI, ISS ESG, Rebecca SAM, Refinitiv, Sustainalytics. There was actually a great project out of MIT called Aggregate Confusion, which quantitatively shows that ESG data are unreliable. So they found the correlation among prominent agencies' ratings was around 0.61, which is very low. So at least for climate, what we need is emissions data across all three scopes at a bare minimum. And I think this would help investment managers, asset owners really understand how to reallocate and drive, whatever is most important for their clients, whether it's dividends or revenue generation or appreciation or whatever the investment strategy is. But right now, there's a lot of noise and unreliability in that noise. But I will say for all of these providers, there is a low carbon version, there is a decarbonized version. It's just not being used as the mainstream benchmark for any other kinds of funds. So that's what we have to change as well.
Thank you, Marilyn. Wendy, I'd like to switch back to you. So I would like to echo first what you said, which is that there seems to have been more attention and more momentum around transition risk than physical risk. And to me, at least, I watch this world pretty closely. It seems like there's a lot more open questions on the physical risk front than there is on the transition risk front. Maybe that's not true, but I think that's one way of characterizing it. What would you, as a large asset manager like the SEC, what would you like to see from the SEC in terms of physical risk disclosure? What would that even look like to you?
Well, since you're giving me the option, I think I should talk about what we'd like to see from them generally. Yeah. Actually, it was great to hear from Professor Jackson, and we have been engaged with many of his former colleagues on this topic of the mandatory disclosures, climate disclosures for issuers. And we've advocated for, there's a public letter if anybody's interested from us to them for scope 1, scope 2, mandatory scope 3 material, scope 3 emissions disclosures across the spectrum in accordance with the GHG protocol. We've also, and we know that the scope 3 likely will be phased in if introduced. We hope it's introduced. We think it's really important. And our message to the SEC and therefore to industry is investors are using that data anyway. Right now, we're buying the data from different data providers, in our case, S&P Trucost and MSCI. We're triangulating across those two data providers on estimated scope 3. If you're not disclosing it, they're estimating it based on an industry average. So if you're better than industry average, you should want to disclose it. You should want us to use your real data to make investment decisions. If you're worse than it, maybe you'd be happy with the industry average. But the information is going to be used. And if you want us to differentiate between winners and losers, then it'd be better for you to control your own destiny and share that information and manage it. So that's number one. On the physical risk side of things, which is something that you asked about, it's been less contentious to offer this idea that companies should disclose their location data, which, believe it or not, they aren't required to do in any consistent form today. So we have interns, Googling location data and sites so that we can more appropriately map our investments and then layer those investments and their sites onto the maps that we create with Woodwell to analyze if they will be inundated by floods, for example, or inundated by hurricanes or subject to increased wildfire risk. In meeting with the various commissioners and staff across the board, they seem to think that that was a non-controversial ask. So it seems to me that it's high probability that the SEC will include that disclosure of location data as part of their recommendation.
Great, thank you so much. Okay, I'm going to turn to Dave. So at the last panel of this series, the first panel of this series, your colleague from Woodwell remarked on the recent consolidation of physical risk providers. So we've seen Moody's, the big ratings agency, buy up RMS, the risk consultant, and also buy up 427, basically the leading physical risk data provider whose data has been used by European regulators to even design their own stress test systems. And I said to you in the prep call for this event that the consolidation concerned me for a variety of reasons. And you actually said something that I found really interesting. Do you want to weigh in on that topic?
Absolutely. And let me just clarify, I wasn't, in our previous conversation, I wasn't endorsing consolidation of the industry. I understand the pitfalls there. But at the same time, we also recognize the challenge with a wide assortment of firms taking a variety of approaches. It becomes just very difficult to assess risk when you're not comparing oranges and oranges. And the different methodologies and the different approaches are inherently problematic. In our comments to the SEC in our letter, we endorsed for physical climate risk disclosure a rigorous, transparent, and standardized methodology so that investors really could kind of have, they could make comparisons. The problem becomes even worse when these variety of firms taking a variety of approaches are also black box firms that are doing proprietary work that can't be tested or checked. So rigorous is very difficult, obviously, to achieve without the transparency part, but we think the standardized part is just as important because those people who are looking to this public information need to be able to know that the comparison of one physical risk assessment can be held up against another, and they can actually be relied upon as starting from the same kind of baseline of methodology.
Great, thank you. So I want to remind everyone to put your questions in the Q&A box. I will turn to those shortly. I also want to take a moment to announce our CLE code, which is RISK, R-I-S-K, surprise. So you can enter that in when you want to get your credit. So do ask questions in the chat. So maybe Dave, maybe it will turn to Nina, but Dave, you can weigh in because it sort of builds off the question the point you just made is how do we think about these proprietary black box models and if they're a problem, and are there analogs in the financial sector already? Like we rely on a bunch of financial services to process data. Is there a reason why climate change is different, or should policy nudge transparency in a different way than it has historically? Like, both of you have thoughts on that question?
Yeah, thank you. I think that's also a very important topic, and we have been asked which data provider or analytics provider our institution should use. So as a regulator, we are not in the space of endorsing any particular one. We're also not in the space of regulating climate service consultants. I know there have been discussions of whether such a regulation is needed. But we are certainly very aware of the dependency of our entities on these consultants. And it's not just climate service consultants, but also asset managers who oftentimes manage investments for insurers and also ESG rating agencies. Especially for the smaller insurers, they often outsource their investment management. So that's why in our insurance climate guidance, we pointed out that insurers should consider whether and how their model vendors and third-party investment managers manage uncertainty and data gaps. Insurers that rely on vendor models for underwriting or third-party managers for investments are still ultimately the owner of the risk, and therefore we encourage them to engage with their vendors and third-party managers to understand their assumptions and the limitations of their models, and also consider the potential large uncertainty in those assumptions. And that, based on this understanding, then design their business models and mitigation strategies. So for example, some insurers may want to reevaluate the risk appetite for certain perils, or reinsurance retention or limits, or whether they should focus on customer engagement if they don't feel like they have the in-house expertise to judge the risk they are taking. Maybe they want to unload that risk to reinsurers and just focus on customer engagement. So I also want to acknowledge that Woodwell provided valuable comments for the guidance and have been very willing to engage with us on climate. So very appreciative of that.
Thank you. Thank you, Nina. Dave, do you want to add anything?
Yeah, well, I'll first of all endorse and agree with everything Nina just said. And as she mentioned, we have worked together and it's been a really productive relationship. Very glad to be a part of that process. The only thing I would add is that we think in order for these risk assessments, for these models to be relied on, they need to be testable and reproducible. And so obviously when you have a black box firm that doesn't allow for that, we think that becomes inherently problematic. The real danger being that firms will go beyond what the science can kind of credibly allow. And you know, if it's a transparent process, then there are guardrails that prevent that from happening.
Great, thank you. So Wendy, I've seen the Wellington video sort of advertising the partnership with Woodwell, and in the very nice trailer video, someone voiceover says, the risks in the market are not mispriced, and we therefore think that this partnership with Woodwell will give us an advantage before the market reprices, and we'll swoop in and buy all the stocks that are going to go up and sell the ones that are going to go down. What makes you so sure that these so if we accept that the risks are mispriced, which is what is sort of driving this whole conversation, what makes you so sure that the market will ever price them?
Great question. So our evidence that I'll give some high level evidence that the market's not pricing these climate risks effectively, and then I'll explain how we think they'll get repriced in two ways. But one, I think particularly easy to internalize example is when Woodwell creates these maps that show how time period over time period, location by location in grid maps, different areas are going to be affected by these risks that we've been talking about, just say heat or drought, et cetera. We then overlay those maps with capital markets holdings, basically the securities that we could or do hold on behalf of clients. One subset of that data is municipal bonds. So a municipal bond is issued to support a particular project in a particular location. So they're inherently location-based. They're inherently long duration. They have a longer maturity to them, and they're generally pretty well priced and well traded. So usually pretty efficient. We can find now examples of municipal bonds that have the exact same financial characteristics, credit quality, yield, duration, et cetera, and very different predicted climate outcomes. And so to us, that is a very tangible example of the market really not pricing these risks. And we extend that analysis to all different types of securities. But that's just a one that I think is pretty easy to internalize. So how does that risk then get priced through time? I think as the market becomes more aware and realizes physical climate risks, and to some extent, as some of this consolidation happens, whether it's good or bad, you see Moody's buying 427, well, then that means that Moody's is going to use 427 to inform its credit quality ratings, and then the value of the issuer or the bond will trade in accordance with that downgrade or upgrade of credit quality based on climate. So some of that is productive if they're going to use it to that end, and then the market starts to feed on itself in terms of trying to interpret that data and incorporate it into analysis.
Great, thank you so much. So Marilyn, how far does disclosure get us? Does disclosure solve climate change?
Why no, Madison?
Really?
So, perfect information is not possible. I mean, in everything, like literally everything, that's probably a true statement. Basic data and measurement are the bare minimum to cure an illness, right? But we still have to do the work with that information. And that means mandates for climate solutions. So there are 3 steps. There's the measurement, there's a disclosure, and then there's a reduction. Without that 3rd step, we're still on team don't look up.
Great, thank you. So I'm going to turn to some of the questions in the chat. I'm going to combine a couple with moderator's privilege. So one question in the chat is, Scope 3 emissions are someone else's Scope 1 and 2 emissions, and there will also be significant overlap in emissions calculations as multiple companies use similar suppliers and downstream services. Is this a consideration at the SEC and elsewhere in requiring disclosure? And I'm going to add that to the one which asks, are you limiting physical risk to assets owned by a firm or extending to the supply chain and customer location, a sort of Scope 3 for physical risk? That's an open question to anyone who wants to weigh in on this question.
I'd love to weigh in on Scope 3 because it comes up a lot, and I'm sure the other panelists have a lot to say about it too. Like, oh, if you have everybody disclose Scope 3, isn't that double counting? Well, it's only double counting if you're like really thinking about this accounting ledger in the sky that's going to add up all of the emissions that exist globally, and you care about what that total number is. The thing which I think is less important, the thing that's adding Scope 3 to the disclosures help you do is analyze each part of the value chain and what they're contributing to it and what their levers are to reducing the overall emissions level, even if it's double counted in the total. So just for example, if you're only thinking about how to analyze a security and you only care about understanding its value or whether it's mispriced, then you still need to understand whether or not its inputs will be affected by changes in opinion or changes in behavior or changes in regulations that would affect basically transition risk for their suppliers. So that could be just a true profit and loss impact if your input costs go up because now you've got a carbon price, or if your input costs go up because now you're demanding more, your consumers are demanding more efficiency on the management of carbon. So that could just be a pure investment decision. But if you're worried about real world emissions reductions, you also want firms to consider in initiatives like the Science Based Targets Initiative and having those targets for net zero require you to consider your upstream and downstream Scope 3. That's material and how you manage them. If you're trying to manage that, then a lever that you have as a large global leader, say Walmart, is that you can say, okay, I'm going to be a net zero company. And so therefore, my suppliers also who supply me also need to be net zero. And you get a net zero club that expands exponentially through time that really does drive the systems change that we're talking about.
Great, thank you. Anyone else want to weigh in? I think in part, maybe I'll direct this towards Nina. The reason why I group these questions together is in part that, climate change is a systemic risk. It's also an idiosyncratic risk. It also affects individual companies. But I see institutional investors increasingly like considering the effects of their portfolio from a systemic advantage. Like they're thinking about the trajectory of the economy. They're thinking about like total emissions. And so as we design these disclosure rules, are we considering the fact that all of these disclosures feed into one another? Like all of the downstream and upstream suppliers' physical risk is also your physical risk. Should we design disclosure standards in such a way that makes that easier to like process? And I don't know, do you even have the authority to do that?
So unfortunately, we do not have the authority
cool.
to do that, but we did submit, I think when the SEC had an RFI, we did submit the letters saying that we strongly support disclosure requirements, because for our banks and insurers to fulfill what we expect them to do, they need the data from their customers, investees, and suppliers, and so on. So our public disclosure requirements are more in terms of how our institutions manage and assess and manage their risk. But like I mentioned earlier, we encourage them to engage with their customers and the companies they invest in order to fill this data gap.
Great, thank you. There's a quick question, Wendy, which is for you, which is what percent of your assets do you actually apply this physical risk analysis that you're developing with Woodwell?
So it's a tricky question to answer because it's not necessarily material to all securities. So we have developed a tool. We refer to it as CERA, C-E-R-A, Climate Exposure Risk Application. That sits on all investors' desktops so that they can have their portfolio through this lens and figure out where we think companies may be exposed. The tool doesn't actually give you the answer. So I think this is an important point to go back to, because you were saying, does disclosure solve climate change? Even if we had perfect disclosure, knowing what to do with that information and making better decisions and making better choices, both at the company level and investor level, really is impactful. So you start with the tool. The tool says, oh, it looks like this company may have significant climate risks. You look at that company and you say, okay, is this company place-based? Does their location actually matter to its value? If it does, then you go to the company's disclosures or conference call notes, and you see if they've mentioned it either from a risk or an opportunity standpoint. Then you meet with the company and you say, hey, it looks like you've just built a plant in a flood zone. What was the rationale there? And they say, oh, we didn't know. And that gives you, one insight about the management team and how forward-looking they are. Or they say, yes, we did, but it's because we're going to decommission it in this way, that way, the other. Or we built these specific resilience measures into our plan, and that gives you another outcome. So in terms of percentage, we're trying to apply it across, in the analysis or the research phase of all of our investments, but whether it matters to an individual investment, depends on all those steps.
Great, thank you. So this is a question for everybody from the chat. So how well prepared do we think public companies will be when the SEC finally finalizes its rule? And what will the challenges be, do you think, of getting this information out there?
Well, I'll jump in and give others time to think. 77% of the market cap of the MSCI All Country World Index, so a global index. I don't have the number for the for the S&P, I should, but 77% disclose scope 1 and 2. That's by market cap, even more so by estimated total emissions. But what that means is there's still a pretty long tail of mid and small cap companies that don't. And that's just scope 1 and 2. And then where the controversy lies is where Professor Jackson was highlighting earlier is scope 3. Only 18% disclose scope 3. And everyone acknowledges that that is harder to do, and it's going to be an estimation, and you need other people's scope 1 and scope 2 to estimate your own scope 3. So maybe a phased approach is going to be the approach there, but never, I think both are important through time.
From a physical climate risk perspective, I'll just jump in quickly. Wendy alluded earlier to the fact that some of the requirements there might be actually very easy to, like disclosing location. That should be pretty straightforward. So we think that there will be some aspects that are easy to comply with. Of course, it depends on how far disclosure requirements go, but at a very base level, the physical climate risk portion should be easier to comply with, I think.
So I don't foresee any challenges in scopes 1, 2, and 3. A lot of companies are actually already internally estimating scope 3. They're not publicly doing it through a sustainability reporting process, but they actually do have those estimates internally. And one example of a good practice is actually transparency around the quality of scope 3. So something that PCAF does, they have a rating or ranking system 1 to 5. And so if it's using an emissions factor database or an estimation, that's rated at 1. But if it's third party audited, verified data, then that's 5. And so I think being very clear about the quality of data is just fine. And so I think we have all we need to have the basic minimum across all 3 scopes, from day one.
So there's something that's, so both Wendy and Dave, you touched on this a little bit, but there's a difference, right? I mean, you know this, between estimating exposure and estimating liability. So, you even if you have the lat and longitude of the desalination, publicly owned desalination plant or something, you don't know what it was built of. You don't necessarily know what the soil under it is made of. You don't know if they've invested in some sort of adaptation measure that makes it more resilient than it would otherwise be based on an average. So there's still this large category of soft information, which the question is, how do you quantify it, or how do you get that very specific internal information, which even the CEO of the company probably doesn't know, have the building specs of the factory. How do you get that stuff out into the public investor space?
So, I mean, you've identified some really big challenges there. We do a lot of work with public sector partners who don't have that information. We're really interested in risk assessments, but the moment you start talking about, the different soils involved, things like that you just run into pretty significant data gaps. I guess my answer would be that taking it as far as you can is better than where we are right now. So the increased information that is more readily available before you get into the soft information you identified would still move us a pretty significant way down the line. That's a much trickier problem, though, that you've identified as to how you kind of what your information you're asking for and then how you collect it.
I think this is imperfect and it doesn't solve the problem immediately, but what we're looking for sometimes is virtuous cycles. And so, for example, kicking off this process and understanding the location data, and then investors who regularly meet with companies and company management teams can start saying, well, tell us about any resilience measures or adaptation measures you have in this plant or that plant. And then once that company management team gets that question a couple of times, then they start to realize that it's important to share that information more broadly with the public. They may start talking about it in all of their investor meetings. They may start talking about it in their conference calls as a point of differentiation. It may, point them to start thinking about what they could be doing on resilience or adaptation. And so you're trying to kick off a virtuous cycle. So getting the data, having it on the scope side, measured and managed, or I liked what was said before, measurement, disclosure, reduction. Without the third step, we're still on team don't look up. That was kind of a scary statement, but I guess it's true. And on the physical side, understanding the location data, understanding its potential physical climate risk, and then asking those questions, and then hopefully kicking off that virtuous cycle of more information sharing and better adaptation practices.
Great. Thank you so much. Well, thank you so much, Wendy, and thank you so much, everyone. We are out of time. I learned a lot as I really enjoyed our time together. I'm going to turn it over to Bethany Davis-Knoll of the State Impact Center, who's going to close us out and wish us goodbye. So thank you all again.
Thank you so much, Madison. Thank you, Nina, Wendy, David, Marilyn, and Rob for kicking us off. And also thank you to Woodwell and the Massachusetts AG's office for pulling these great panelists together. This was fascinating. This was a great discussion. I hope to see you all back here on March 1st to talk about using all of this robust information and engaging with your regulators to promote resilience and environmental justice in decision making. So thank you all, and we'll see you again soon.